Welcome to Learn or Be Learned. This is the podcast show where I read books and show how you can apply it to your life. And, like a true anthropologist, I dig up stories on what people are up to and how that can impact you as well. I'm your host, Shiva Danashekar. This is episode 14, and let's read. So this book is called Unshakeable, Your Financial Freedom Playbook by Tony Robbins with Peter Malik. So I'm going to basically just jump in and tell you the basics on what this book suggests on how and what you should invest in, and mainly just some mindset things. This book gets super technical, so if you want to know the reasons behind it or more about the technical side of it, you should check out my LinkedIn page where I will be talking about this book in more depth. So let's talk about the beginning, right? So they say money is only a tool. It will take you wherever you wish, but it will not replace you as the driver. And another quote, they say emotions are your enemy. See, these are two really important things. I just want to touch on them. Think about it, right? Money is a tool. You have to understand what you're doing. Are you chasing money or chasing what money has to offer you? If you're always saying,
oh, my life would be better if I had this amount of money to do this.
Well, it all starts with your mindset. It all starts with, how do I do that? How do I grow my business to afford this? Or how do I increase my assets to self-pay for this thing, right? Or for this trip or whatever. So money is only just a tool. And that's why the wealthiest people aren't emotionally attached. And you might say, oh, well, obviously they're not emotionally attached. They have millions, billions, whatever. But, they started at the same spot as anybody else, most of them at least. But the mindset seems to be the same no matter who they are, right? Whether Warren Buffett, when he started at 14, had 5K net worth, or now where he's around 83 billion or something, his mindset never changed. If anything, it evolved and he understood it and understood the process more, but the essence is still the same. And then they talk about how emotions are your enemy, right? So when you're investing, if you're emotionally attached, you're going to make irrational decisions. You make the most rational decisions when you're calm. That's why you need to try to avoid emotions. And we're, humans, so we're emotional creatures. But you really have to, when you invest money, you have to assume that it's gone already, and that's the best way to just tame your emotions. So let's jump into this, right? I want to just first say he mentions that all of the proceeds from the book go to Feeding America, which is his nonprofit, but it's still a really good deed, so I kind of like that. And he does briefly endorse the Creative Planning Company, which he's the chairman of, that's kind of how it be. But anyways, stocks, right? This wouldn't be a financial advising and investment book if we didn't talk about stocks. So they talk about how you need to recognize patterns in the market and not get emotional, right? You need to understand that the market has almost always made an increase in return over a 10-year period. Who said investments are for short gain, right? But, you might know these people that are like, oh, well, I flipped this cryptocurrency, right? The Forex currencies or stocks, and that's fine. Even some of the best financial experts, Ray Dalio, another billionaire, they talk about how you can't predict the market in the short run because it's run by people demand, right? Think about Dogecoin or GameStop recently that reached $300, $400, $500. The market can be unpredictable, right? So you need to be emotionally stable and diversify your portfolio. But also look at Warren Buffett, the billionaire. He had a net worth of 1 million at the age of 30 and 1 billion by the age of 56. This is a man that knows about compound effects and compound interest, right? Warren even says, my wealth has come from a combination of living in America, some lucky genes, and compound interest, right? So, the biggest danger is not the correction period, which is, a drop in investment or stock by 10%, or the bear market, which is a fall below 20% in its peak. It's being out of the market. It's pulling out and being scared, so you take out all your money and take the loss. Because like we said, over a 10-year period, it should give you capital gain. But this is also, you got to know which stocks you're working with. And that's the thing. This book isn't telling you what to invest in. It's telling you how to invest in it and how to think. So, corrections happen once a year on average, and bear markets happen 3 to 5 years. So you have to expect anything you invest in stocks and stuff will fall, which is why you have to be emotionally disattached. So then you might be wondering, so Shiv, what is the safest way to invest, right? Well, according to Tony Robbins, and obviously do your research, but investing in low cost index funds like the S&P 500 is a good bet. Basically, this is a kind of like how stocks work. It's kind of a stock where it's just a collection of the 500 best stocks, and then it kind of just averages around, and over time it gives you a yield. So you should look into that. Low cost index funds is a good way to go. Likewise, they talk about 401k plans, and in theory, they're a beautiful idea, but they're pretty bad. So let me tell you why. They have too many hidden and undisclosed fees attached to it, and they take it out of your paycheck and you don't even know, and they don't even have to tell you what fees. Companies that seem to care or actually find out the truth are switching to other companies that don't have these hidden fees and are actually trying to help their employees. So you should definitely look into whether your 401k, if you have one, is truly helping you, right? So let me give you a short example of the many categories of fees that they can, randomly bring up.
You got investment expenses, communication expenses, bookkeeping expenses, administrative expenses, trustee expenses, legal expenses, transactional expenses, and stewardship expenses.
Why not, like Tony Robbins says, why not add a category called expenses, right? It's just bullshit. You need to look out for yourself, and knowledge is your first weapon of defense, right? So you need to understand this and do your own research and look into seeing if your 401k has all these hidden fees and whether it's worth investing in, because they did. So there's an example in the book, and it says they calculated the fees of a 401k on an average worker who owns $30,000 a year, right? And they save 5% of their annual income, and over a lifetime, this worker would have lost $154,794 in fees, right? So that's almost 5 times their income, 150K versus their 30K a year. A worker who earns about 90K would lose $277,000 in 401k fees alone. You have to do your research and look into this. So if you're looking for a financial advisor, and here's the basic gist of it. Brokers are bad because they're not legally required to look out for you, and they mainly just look out for themselves. Independent advisors, also known as RIAs, are legally required to help you and put your best interests forth. But Tony says this is a little bit more rare to find, but they're definitely worth it. Like, you need to look for independent advisors, and they're completely worth it. And dually registered is also bad because that just means they're both, and they can switch to being a broker. And like we said, being a broker as your financial advisor, probably a bad idea. So if you want to know the technical behind all this and be like, what, why, Shiv? Look out on my LinkedIn page, because, I'm going to talk about all the details there, and it gets really technical, and this would be like a 50-minute episode if I had to explain all the gist of all that. So that's the main summary of financial advisors, and they're really good because they help you diversify your portfolio and, learn more about investments and how to, assess risks and stuff. So this concept actually was a little mind-blowing to me. They said, apparently the biggest rule to wealth is not making money, it's preventing from losing it. You're like, oh, well, that sounds really self-explanatory. Why is that mind-blowing? Because the wealthiest people don't actually focus on how they can make money. They focus on how not to lose it, right? Right? So think about it. If you had 100K and you invested 50% of it, you invested 50K into something and you lost it, right? Complete zero, you have nothing, right? So you lost all of that. Now, how much are you going to have to make in order to get your money back? And the first answer some people might say is 50%. Actually, no, because if you got 50%, that only put you at 75K. And that means you still need 25 more K to get back to your starting position. You'd actually have to make 100% gain in your next investment in order to start back at zero, right? So that is why wealthy people focus on not losing money rather than the making aspect. So, I'm going to wrap up some other ideas here. So we talked about stocks, but so here are 3 quick other good investment strategies and 2 bad ones. We have real estate investment trusts, or REITs. REITs are great because basically you can invest partially into assets of like apartments, hotels, shopping malls, etc. Private equity funds are basically where an investor will pool in money from people called a fund. And once the investor has a high enough fund, or private equity as it's called, they will buy out companies and attempt to flip it for higher or invest in companies. So you can pool in the money here. Tony says this is also a good idea. MLPs, or master limited partnerships, are publicly traded partnerships where they typically invest in energy infrastructure like oil and gas pipelines. They give you a lot of tax efficient benefits, but are only good for if you're around 50 or older and have large taxable accounts. They're not really the best for young investors or people that have money invested in an independent advisor. Lastly, he talks about two bad investments, one of them being gold, because historically, according to Tony in this book, stocks, bonds, energy commodities, real estate, and, to my knowledge, cryptocurrencies are doing far better than gold does. And he also mentions hedge funds are bad. They don't generally look in the best interest for you, so I would stay away from that too. And, I guess just to wrap this up, like I said, if you're looking for a depth guide or explanation to why some of these statements I made are the way they are, you should definitely look out for my LinkedIn page. I know I mentioned that several times in this, but I can't stress enough how technical this book was. It took me a little longer to understand it, right? And I wanted to give you the quick facts of what this book is basically mentioning, and then some quick mindset shifts. But, the technical aspects of why is an independent advisor better than a dually registered advisor better for you, right? And what questions should you ask yourself when you're looking for one? All these things would, have made this episode super long. So in order to keep it short, I decided to just give you the basic summary and application of it. So, like I said, these are just suggestions. You are not guaranteed to make money from these ideas. These are more on what to do, not where to do them, right? So you should definitely do your own research and what interests you, and you may want a financial advisor to help diversify your portfolio. These people are experts in investments, but they are still human. So do your research, figure out where and what to invest in, but remember, most importantly, two things from this book. 1, keep your emotions out, and 2, don't put all your eggs in one basket. Also, did you know that salt used to be used as a commodity for trading? Well, if you didn't and you want to learn more, tune in next week where I talk about the book Salt, A World History by Mark Kurlansky, where I'll basically talk about the most interesting facts about how this was traded, how it provoked financed wars, secured empires, and inspired revolution. So look out for that. Like always, thank you for staying to the end. Please give me a review on Apple Podcasts. And if you have any other book suggestions or episode suggestions or want to be a guest, check out my website or email me, and my email is in the podcast description. And like always, thanks for watching. Peace.